Goldman Sachs GPIX. Should you drip or no drip? Which one pays you more income? Should you reinvest your dividends or should you cash out and take the full income? Hey everyone, it's Doug, the retirement guy with all your monthly ETFs. And I got asked this question by a couple of our Patreon supporters and said, hey, what should I be doing? Now I know in each situation is a little bit different. Personally, I'm a no drip guy. I need the money, I need the income to live off of in my retirement planning. But there's other people saying, hey, I would like to do a drip, no drip. So I thought I'd take down and do a complete breakdown of both categories and see where it all falls out. Is it worthwhile doing one or the other? So before I go any farther, I got to do a shout out to all of our Patreon supporters. Thank you so much. And if you're not one of our Patreon supporters, I highly recommend you sign up. It's free. You can sign up under the free program. A lot of information out there. And we have just added a whole new crew to start adding more and more to our Patreon with working out with a newsletter and just monthly updates onto it. And a lot of times getting information like this long before it hits the airs of YouTube. So if you want to support the channel and if you want more information on retirement, don't be afraid. Hit our Patreon. Past performance does not guarantee future results. The information provided in this video is for educational information only. I am not a financial advisor. Always talk to a professional advisor before making financial decisions. So let's first pop the hood on GPIX. This is Goldman Sachs's baby. It came out October 24th of 2023. So realistically, we got a good 2 years under the belt already with this program. They have $3.24 billion in net assets. And here's the one thing I love. The expense ratio, 0.29%. That is dirt cheap on a lot of these type of ETFs. There's 63 million shares outstanding. It has a 8.49% dividend yield. And, we're not always chasing dividend, but we want to make sure this is part of it because this is in my personal retirement package as an income generator. And it pays out $4.3 in dividends over the past 12 months. It does pay out monthly. And when we take a look at the numbers, look at the growth, 8.92%. Over the past year, it did have its drop off on April 2nd, and it's totally recovered since and has been bouncing right around that same area across the board. So it holds very strong at 8.92% growth. Add in that yield of 8.49%, you can see this is really a 50-50 blended piece that you get growth with yield for a total return of 18.59%. When we look deeper into this one, you will see since inception, the average is 20.85% over since inception, which is, like I said, a little over 2 years old. 1 year, 18.59% as a total return, which is your dividends and your growth. Now, over the past year to date, remember, year to date at this point, about 2.5 months, we're down only about 1.93%. That's primarily because everything that's going on right now, when we sit and talk about is, the war in Iran, the Venezuela situation. So a lot of things global politically is happening. So it's not an infrastructure problem. What it is really just a global policy problem and bad news cycles. Over the past month, which is the real guarantee of it, is down 2.26%. So you can see the year to date was doing great until the last 30 days. So let's show you what I did here. This is doing what we call backtest parameters. So I take $500,000 as an initial investment in the computer program. We go back to, and the starting date of this one was December 4th of 2023. This is when it really got into its first dividend payments, got things rolling. I said, okay, this is where you want to start at. You can always go back to the very first day of trading, but I don't think anybody would ever buy on first day. You want to see how it works out. So this is why we put it at December 4th. The starting price for us was $42.59, which allowed us to buy a little over 12,327 shares. Now, the scenarios that we're going to track is first, A, is full reinvestment drip. That's 100% of the dividends are automatically reinvested in to buy more shares. Then I threw a stinker in there, and it's going to be the B category, which is 50% drip. Now, if I could ever figure out a company that would set this up automatically, it'd be phenomenal. But, I'm using Charles Schwab, I'm using Fidelity. Doesn't always work that way. But the 50% drip, half the income is taken in cash, the other half is reinvested for growth. And then we have the zero drip, which is really what I'm on with most of my funds, is maximizing the income strategy for all the dividends are taken out as cash distributions. So starting at the share price of this journey, you can look at this back in December, it was 42.59. The thing had a nice steady growth all the way up to just a hair over $50 price tag. Then we had that Liberation Day, the tariff panic and the sell-off of everything went, and it almost literally came back down to its starting price. But it took an immediate turn and came right back up. And so total appreciation over this period of time of over 35.43%. So despite the sharp 12% drawdown during that April tariff scare, GPIX recovered faster than the broad S&P 500, which is the equal weight index. So this is the thing. Recovery strongly ending up a period with over 35% per share alone. It tells you that the fund has good fundamentals. It has a good foundation to work from, which is why Goldman Sachs and with retirement funds has always been one of those funds that we've said, hey, take a look at this, see if this is going to be a fund that's going to work with you. And I just show you, it really has done well over a short period of time. Now let's take a look at the income analysis. And this is the monthly distributions. The starting payout was about 31 cents per share, which was quite impressive on a new fund. Giving 30 cents, basically you're looking at almost a penny a day for every share that you own coming to you. The ending payout is up to 37 cents. So it's about a 19% growth in income by really doing nothing other than letting them do their process. So the average payout right now over 26 months is actually about 34 cents per share. Now, as the share price grows, the distributions have trended upwards, giving investors literally a pay raise over the last 2 years. This is another big piece of why I like this fund so well, is that not only are you getting a fairly smooth income from it, what you're also getting is a pay raise. You're getting slowly increases into that distribution. Now, these things can all change. I always want to clarify this and make sure everyone understands that these numbers are, they're past history. It's based on actual distribution history, but these things can change in a heartbeat. So don't always just say, well, I can buy this because he said this is going to get 37 cents. This thing could drop off. They have the policy of never paying dividends. So nothing's ever guaranteed. But it just shows you how you look at a fund, track different things, and overall have to make a decision of how well it's actually doing. So let's get into our drips, our full drip strategy. Now remember, the full drip is where we get that distribution, that 37 cents from last month. We just take every dollar from that and we buy more shares. And the positive of doing a full drip is as the price of the market goes up, down, so the higher it goes up, less shares you buy. But when it goes down, you're buying more shares. It's kind of like you're cost averaging across the board. So the ending value, our $500,000, ended up $854,000. That's about a 62% total appreciation. So the annualized return, 31.2, we added to almost 2,500 additional shares from the distributions. Now we've taken no cash out. Okay, so this is great if you are planning on, I always say, retiring 5, 10, 15 years down the road. You do full drip automatically. I mean, there's even actually no question to it, because do you really need to take the cash out? No. But what you want to do is continually buy more and more shares by dripping your dividends, pouring it back in. And that's what's going to give you that 18% distribution total return across the board. And you can see in our chart how that thing just rocketed right up. So if you don't need the cash and reinvesting everything, your $500,000 will basically turn into $850,000 in just over 2 years. Now, this is just past performance. Remember, past performance is not guaranteed. It's just the information that was there at the time of the video. So the power of compounding yield on top of the price appreciation makes for a huge difference. Now, this is the one that gets a lot of people interested and excited as well. You take that same $500,000 and you take 50% of it and you take your money off the table, and the other 50% you buy more shares. The portfolio would have gained basically 48% in the portfolio. 59% total return in doing it this way. Now, the cash you would have received was $57,000. Now, $57,000 for a lot of people was not bad. I mean, that's a realized income for a lifestyle. That's averaging about $2,375 per month income. So I talk to a lot of people, and they're sitting there, we're close to retirement. We're slowly developing this. This is where I start suggesting people put things out. Go to a 50-50 blend. You have to do it on your own manually. You can't do it automatically unless someone knows different. If you do, put it down in the comments. Help me out as well. If you have anyone that you know that can do a 50-50 automatic split. But I haven't found it yet. So I don't know everything. So if you guys help out, awesome, help the channel. So this is what one of these big things can do. So you're looking at reinvesting $57,000 and taking $57,000 off the table. Not bad number. So this is like what I always call the sweet spot for many people. If you took $57,000 in cash to live on, and your portfolio is still growing by about 48%, it's a powerful way to supplement your lifestyle without depleting your nest egg. There's multiple ways of having this. I always suggest this on someone who's just starting into retirement. You may be a couple years away from retirement. You may be into your last year of working and you're starting this. You start doing this so you can start learning and budgeting and figuring out how much money you're actually going to have, even though you're still growing. $57,000 is pretty darn good. You add in Social Security on top of that, you almost could retire off of that $500,000 put into this only 2 years ago. So it makes for a big difference. So you can see the difference between 100% and the 50%. Now, zero drip. This is going to be in Doug's category. This is where I'm going to sit. So basically what you would have received was $110,000, okay, over those 2-year period. So it's about $55,000 per year. Your ending value portfolio would be $711,000. So you still had growth. Your funds have still grown. Your policy has grown. But you've taken the dividends off the table and put them in your pocket to live on. This is being what I call into retirement, and well deep into retirement is how this one would work. So you get the nice positive growth. And if you've ever watched any of my videos of the 3-bucket system, this was a great one that you could put into your growth and income folder, giving you good income, but also gaining you growth across the board. Instead of always just putting this all for income, you could actually put this into the income growth package and still have a nice total package for your portfolio. And if you haven't watched the video, don't be afraid. It's in our system. We'll link it at the end of this video. It's a great video to be watching for. So even if you took every penny of income, which is what I would do, which averages about $55,000 a year, your portfolio would still grow by $186,000 in unrealized gains. Unlike yield trap funds that erode your principal, GPIX has captured significant market upside. So this is why I always suggest people, if you got to look at different funds, you got to see what funds fit you the best, where it falls into. And this one here, zero drip is maximum income. So to give you the final verdict, or to show you the comparison of the scenario A, full drip, scenario B, 50-50, and scenario C, the zero dripping. Now, you can say what you want. Your ending balance, $854,000 with dripping it all the way through. As I said again, you're building building wealth. You're building your future pot that you're working with. So that's why I always say, if you're into that, 5 years out, 10 years out, full drip is automatic. You get within that 2 to 3 year mark, I really tell you, you just may be over to scenario B, but you could still full drip. 50-50 split is when you're starting into your retirement, or you're just that year away from retirement. Like I said, just 2 years out, you start at 50-50 because you want to start learning about, you really want to learn about what the future is going to be. How am I going to budget my money? It's preparing for the future. What's my money going to be? What's a check look like? You have a year to look at. Well, I get $2,000 a month. I got $3,000 a month. You balance it all out. So here you'd receive the $57,000 and a total return of 59%. So you look at the two between green and blue, there's not a big gap between the two. And when I say that, you're looking at what? About a 3% difference between full drip and 50-50 split. Then we get into scenario C, and that is the zero dripping. Your funds still grew $711,000. You received $110,000 in cash for a total return of 56%. So it's only 3% better with a 50-50 split, and it's really a 6% gain by doing full drip. So where are you at in life? Where do you hold it at? It always tells you where you want to be at the end. Now, this is a 2-year summary. Okay, so you remember, this is 2 years of work on this one. So these numbers it's not an overnighter, and don't think you're going to get rich quick. This is one of these things that's going to take some planning to go through. So the data that we've shown on the GPIX, growing principal even while paying out, what's your strategy? Are you holding GPX for the growth potential, or do you prefer the higher yields at JEPQ or QQQI? If you're doing a 3-bucket program, is this in your income bucket? Is this in your income growth bucket? Or is this a foundation fund? I'd love to hear from you guys. Let us know. Leave a comment down below. I'd love to hear what you guys have to say about it.
Thank you for watching. Press the